As the U.S. economy drifts closer to a recession, there are 13 states poised to feel the impact before anyone else, and the fallout is likely to be severe. If you currently own property in any of these places, what we're about to walk through could be the difference between staying afloat and facing serious financial harm. At this very moment, even as real estate agents continue to insist that now is still a smart time to buy, we're examining foreclosure numbers released just last week, and they tell a very different story. Those figures make it clear that we're already slipping into crisis territory. In fact, housing conditions in 13 states are showing unmistakable signs of collapse as we speak. Before we go any further, let me ask you something. Are you aware of which state experienced a 145% surge in foreclosures in just 1 year? Or which state is now recording one foreclosure for every 1,829 homes, all while property values are dropping at the same time? If those answers aren't immediately obvious to you, then you'll want to watch this entire video. We're about to break down the three specific triggers that are colliding right now and identify exactly which 13 states are officially in the danger zone based on November 2025 data. What's unfolding here goes far beyond a routine housing slowdown or a mild correction. This is financial damage happening in real time. You're either going to understand what's coming and prepare for it, or you're going to be blindsided by it. In October alone, foreclosure filings reached 36,766 properties nationwide, marking a 20% increase compared to the same time last year. At the same time, home values are slipping. The median asking price per square foot has dropped to 1% below 2024 levels, and momentum continues to weaken. The Case-Shiller National Index is barely holding on, showing just a 1.5% year-over-year increase and clearly drifting toward negative territory. Here's the part most people aren't talking about. These warning signs aren't evenly distributed across the country. Instead, they're heavily concentrated in 13 states, where three extremely dangerous forces are all coming together at once. Let's break down the three triggers that are creating this perfect storm. Trigger number 1. Foreclosure activity is exploding during what's supposed to be an economic expansion. When foreclosures jump 20% year-over-year while unemployment rates are still being reported as low, it signals deep structural weakness. If a full recession hits under these conditions, the results will be devastating. Trigger number 2. Home prices are falling at the same time foreclosures are rising. This combination is especially destructive. Declining prices erase homeowner equity, which leads to more strategic defaults. Those defaults add even more distressed properties to the market, pushing prices down further and accelerating the collapse. Trigger number 3. State-level fiscal crises are blocking intervention. When housing markets implode, these states simply don't have the financial resources to step in with assistance programs, bailouts, or economic relief. There's no safety net left to deploy. Now that you understand the mechanics behind the collapse, it's time to look at where this is already happening. Let me show you the 13 states where all three of these triggers are already active, starting with the top 5 states most at risk of collapse. Number 1. Florida. Florida now sits at the very top of the foreclosure rankings nationwide. As of October 2025, the state is seeing one foreclosure for every 1,829 housing units, making it the most distressed housing market in the country. In that single month alone, Florida logged 5,512 foreclosure filings, a staggering number by any measure. What makes this especially dangerous is that foreclosures are climbing at the same time home values are dropping, the exact scenario that historically triggers full-scale housing market breakdowns. What's unfolding in Florida goes beyond a typical downturn. The warning signs are everywhere. Homes in Miami are sitting on the market for an average of 69 days, the longest timeline in the nation, while inventory is surging across multiple metro areas. Cape Coral saw listings jump 51% year-over-year, Northport and Sarasota climbed 48%, and Fort Lauderdale inventory rose 30%. These aren't normal seasonal shifts. This is fear-driven selling. The catalyst behind this rush to exit isn't interest rates. It's the insurance crisis that rarely gets headline coverage. Average homeowner insurance premiums in Florida have now climbed past $11,000 per year, compared to a national average of about $2,500. That's an increase of roughly 340%, and it's forcing homeowners to sell regardless of their mortgage terms. For many, keeping the house simply isn't financially viable anymore. Climate risk pricing has finally caught up with Florida, and the consequences are severe. Buyers are backing away, longtime residents are leaving, and once booming markets are seeing a sudden reversal. The state recently recorded a natural population decline of 7,321 people, while domestic migration has fallen off a cliff, dropping from 222,100 new residents in 2022 to just 68,043 in 2024. Florida's growth model depended on migration levels that no longer exist. At the same time, serious mortgage delinquencies are rising in areas where home prices are already slipping. When declining values collide with increasing foreclosures and a shrinking population, the result is a cascading failure across the housing system. Florida isn't dealing with a single problem. It's experiencing multiple crises all at once, stacking on top of each other. That's what makes it the clearest, most extreme example of a housing market unraveling in real time. Number 2, Colorado. Colorado has delivered one of the biggest and most unexpected shocks in the country. The state recorded the largest year-over-year surge in foreclosures nationwide, with filings skyrocketing 145% compared to last year. In other words, foreclosures didn't just rise, they more than doubled in a market long viewed as safe and resilient. This sudden reversal exposes how surface-level stability can hide deep structural weaknesses that erupt without much warning. At the same time, Colorado is dealing with serious fiscal turbulence. In less than a year, the state swung from a comfortable budget surplus to a projected $750 million shortfall for fiscal year 2026. That kind of financial whiplash points to economic stress that many analysts completely overlooked until it was already unfolding. Housing supply pressures are also intensifying. Inventory levels have now climbed above their pre-pandemic 2019 highs, while foreclosure risk continues to grow, with 1 out of every 4,529 homes currently facing foreclosure. These conditions are unfolding as Colorado's economy grapples with uncertainty tied to its heavy reliance on the technology sector and shifting remote work policies. Even Denver, which was one of the most popular migration destinations during the pandemic, is showing cracks. Office vacancy rates remain elevated, signaling weaker demand and reduced economic momentum. Much of the state's recent development was built to support pandemic-era growth patterns that are now fading, leaving behind classic oversupply conditions across both residential and commercial markets. The lesson here is clear. When foreclosure activity more than doubles during what's supposed to be an economic expansion, a recession doesn't just slow things down. It turns an already fragile situation into a full-blown disaster. Colorado illustrates the danger of boom and bust cycles, where rapid pandemic-driven growth justified higher spending. But as that growth normalizes, massive fiscal and housing gaps emerge almost overnight. Number 3. Illinois, the pension death spiral. Illinois is trapped in one of the most dangerous financial positions in the country. The state combines persistently high foreclosure rates with an overwhelming $144 billion in unfunded pension obligations, a problem that isn't just severe, it's mathematically impossible to solve under current conditions. Pension funding stands at just 46%, placing Illinois firmly in distressed territory, while total pension liabilities have ballooned to roughly $248.7 billion. The state's debt ratio of 468.7%, the highest in the nation, underscores just how extreme the situation has become. This financial pressure is already pushing people out. In 2024 alone, Illinois lost 56,235 residents to domestic migration, ranking as the third largest population outflow in the country. That exodus fuels a vicious cycle. Fiscal strain drives residents away, shrinking the tax base. To compensate, the state must either raise taxes, which encourages even more people to leave, or cut services, making Illinois less livable and less competitive. There's no clean exit from this loop. What Illinois is experiencing isn't a sudden crash, it's a slow-motion collapse. Pension payments consume an ever-growing share of state resources, squeezing out everything else as the pool of taxpayers continues to shrink. When housing markets begin to fail, Illinois has virtually no fiscal room to intervene. There's no spare funding for homeowner assistance, no capital for infrastructure upgrades, and no meaningful buffer once economic conditions deteriorate. While Chicago home prices recently showed a 6.4% increase, that headline number masks deeper risks. Those gains sit on top of already elevated foreclosure activity. When a recession arrives, Illinois is positioned for a brutal correction. Foreclosures will surge, distressed properties will flood the market, prices will fall sharply, and the tax base will continue to erode, all while the state lacks the financial ability to step in and stabilize the damage. Number 4. South Carolina. The silent crisis. South Carolina is quietly slipping into one of the most severe housing situations in the country, largely unnoticed by the national conversation. The state now holds the second highest foreclosure rate nationwide, with one foreclosure for every 1,982 housing units. While it hasn't made many headlines, the level of housing stress unfolding here is anything but minor. Recently, South Carolina recorded more than 1,000 foreclosure filings, and the damage isn't confined to a single city or neighborhood. Counties like Dorchester, Kershaw, Berkeley, and Oconee are all showing significant distress at the same time. This isn't a case of isolated trouble spots. It's evidence of a broader, regional failure spreading across multiple parts of the state. That kind of geographic concentration matters. When foreclosures surge across several counties simultaneously, it points to statewide economic pressure, not a localized housing glitch. South Carolina's economic structure only amplifies the risk. The state relies heavily on manufacturing and tourism, two sectors that historically take the hardest hits during recessions. With limited economic diversification, South Carolina has very little insulation against a housing downturn paired with rising unemployment. The current foreclosure pattern makes one thing clear. This isn't just a housing market issue. It's the early stage of a wider economic breakdown that will accelerate sharply once a recession sets in. Smaller and mid-sized economies like South Carolina simply don't have the capacity to absorb broad regional shocks the way larger, more diversified states sometimes can. When the next recession arrives, South Carolina's existing foreclosure problems are likely to escalate rapidly. Manufacturing activity will slow, tourism revenue will dry up, and the housing market will be hit from both sides at once. Without strong fiscal reserves or a diverse economic base, the state lacks the tools needed to step in with meaningful support, leaving homeowners exposed as the crisis intensifies. Number 5. California, a multidimensional collapse. California is dealing with the most complex and far-reaching crisis in the country, with multiple failures unfolding at the same time. The state is staring down a $58 billion budget deficit alongside nearly $498 billion in total liabilities, all while experiencing the largest population loss in the nation, a net outflow of 239,575 residents. That erosion of the tax base is happening at the exact moment when government spending pressures are at their peak, creating a financial equation that simply doesn't balance. Housing supply has exploded across the state. Active listings have surged, with several counties seeing inventory increases of 100% or more. San Bernardino County listings jumped 120%, Kings County rose 130%, and Ventura County climbed 50%. At the same time, the average days on market increased by 41%, stretching from 22 days to 31 days. In a state long defined by rapid home sales and intense competition, these shifts signal dam-burst conditions rather than a normal cool-down. Labor market stress is adding fuel to the fire. California's unemployment rate has climbed to 5.5%, the second highest in the country, while multiple major metro areas are already posting price declines. San Luis Obispo is down 1.9%, and Sacramento has slipped 1.8%, confirming that weakness is spreading beyond isolated pockets. The business exodus only compounds the damage. Between 2011 and 2021, California saw 789 companies relocate, and from 2018 to 2023, 8 Fortune 500 headquarters moved out of the state, a trend that has accelerated recently. On top of that, unfunded pension obligations alone total roughly $265 billion, adding yet another layer of fiscal strain. As residents and businesses continue to leave, the shrinking tax base forces the state into an impossible choice: deep service cuts or higher taxes. Both options drive even more people and employers away. That feedback loop creates a true death spiral, where financial stress and housing instability reinforce one another, worsening both crises at the same time. Before we move on, take just a second to support the channel by hitting like and subscribe if you're finding this breakdown useful. Every like, share, and subscription helps us keep producing in-depth content like this. Thanks for being here. Now, let's keep going. Number 6. Delaware. Small state, maximum vulnerability. Delaware may be small, but that size is exactly what makes its current situation so dangerous. The state posted the highest bankruptcy rate in the country, with more than 1,200 filings in 2024, up sharply from 897 the year before. That jump means over 1% of all businesses in Delaware entered bankruptcy in a single year, a clear signal of widespread financial strain beneath the surface. Housing conditions are deteriorating alongside business stress. Delaware now ranks among the worst states for foreclosures, with 1 in every 2,617 housing units affected. At the same time, unemployment has climbed noticeably, rising from 3.7% to 4.3%, adding further pressure to households already stretched thin. In a state this small, problems don't stay isolated. Delaware lacks the economic scale and diversification needed to absorb major regional shocks. Any disruption hits harder and spreads faster. That vulnerability is magnified by its proximity to struggling neighboring economies like Pennsylvania, Maryland, and New Jersey, where housing and fiscal stress can easily spill across state lines. Taken together, these factors leave Delaware highly exposed to cascading failures. When surrounding regions weaken, Delaware has very little buffer to slow the impact, making even modest downturns potentially severe once a broader recession takes hold. Number 7. Nevada. A tourism-driven economy on the edge. Nevada is showing clear signs of stress as its visitor-dependent economy begins to crack. The state posted the highest annual unemployment rate in the country in 2024 at 5.6%, and even now, joblessness remains elevated at 5.3%. Those labor market pressures are already spilling into housing, where home values have started to slide in key markets. In Reno, prices have dropped roughly 3.6%, bringing the median home value down to about $612,200. Las Vegas is also moving lower, with prices slipping 0.5% to around $481,000. These declines may look modest on the surface, but in a state built on constant demand and rapid turnover, even small price drops can signal much larger problems ahead. Nevada's vulnerability comes from its heavy reliance on gambling, hospitality, and tourism. Those industries thrive when consumers have extra money to spend, but they're among the first to suffer when discretionary spending tightens. If households cut back, Nevada's economic engine slows almost immediately. The risk is compounded by the fact that Nevada depends on visitors from other states, many of which are now dealing with their own economic and housing stress. As those source states weaken, fewer tourists travel, fewer dollars flow in, and Nevada absorbs a double hit. In a recessionary environment, that structure leaves the state especially exposed to a rapid and severe downturn. Number 8. Texas. The overbuild reality check. Texas is running headfirst into the consequences of massive overbuilding. The state now has the 4th most oversupplied housing market in the country, with inventory sitting 53% above normal levels. By April 2025, active listings had climbed to roughly 123,000 homes, flooding the market with supply just as demand is cooling. One of the biggest drivers behind this imbalance is the sudden slowdown in migration. Net domestic migration into Texas has collapsed by 62%, falling from pandemic-era highs of 222,100 new residents to just 85,200 in 2024. Builders and policymakers plan for growth rates that simply no longer exist. Despite that slowdown, Texas continued to build aggressively. The state issued 15% of all new home permits nationwide, adding even more supply into an already saturated market. The impact is becoming especially visible in Austin, where prices are now projected to decline by 12.2% as the classic oversupply cycle takes hold. The problem isn't just housing, it's timing. Texas expanded as if the migration boom would last indefinitely, but as population growth normalizes and economic fundamentals soften, the excess supply becomes impossible to ignore. What once looked like unstoppable momentum is now turning into a painful market correction. Number 9. New York, the commercial real estate cascade. New York is facing a chain reaction that begins in commercial real estate and spreads outward into the broader economy. In Manhattan, office vacancy rates now range from 17% to nearly 19.6%, while Class A office rents have fallen between 6.8% and 8% year over year. These declines are unfolding as the state carries roughly $368 billion in total debt alongside a $34.3 billion cumulative structural deficit, leaving very little room to absorb further shocks. Population losses are making the situation even worse. New York saw 120,917 residents leave in a single year, marking the second-largest domestic outflow in the nation. A significant share of that wealth exited with them, including $13.7 billion in personal income that relocated to Florida alone. That drain weakens both consumer spending and the tax base at the same time. When commercial real estate collapses, the damage doesn't stay contained. Falling office values hurt not only property owners but also the banks and lenders that finance those buildings. As downtown business districts weaken, the ripple effects spread into residential housing, local employment, and municipal revenues. What's happening in New York is a classic cascade failure. As commercial cores deteriorate, housing markets lose support, financial institutions absorb losses, and urban economies begin to hollow out. Once that process accelerates, it becomes extremely difficult to stop, especially in a state already burdened by debt, deficits, and accelerating outmigration. Number 10. New Jersey, when pension pressure collides with rising foreclosures. New Jersey is caught in a dangerous squeeze where long-term pension obligations are colliding with growing housing stress. The state is carrying roughly $92 billion in unfunded pension liabilities, which works out to about $9,688 per resident. Despite those mounting obligations, recent data shows New Jersey now ranks among the states with the highest foreclosure rates in the country, even as home prices have still managed to rise by 8.1%. That contradiction alone signals deeper financial trouble beneath the surface. Labor market conditions are also moving in the wrong direction. Unemployment has climbed from 4.6% to 5%, adding pressure to households already struggling under the weight of the highest property taxes in the nation. For many homeowners, rising taxes and living costs are erasing any benefit gained from higher home values. The pension problem itself has no easy solution. Closing the funding gap would require either massive tax hikes or significant benefit cuts, and both options are politically toxic, especially in a state where foreclosure stress is already appearing in markets that are technically still appreciating. That's what makes New Jersey so vulnerable. When foreclosures increase even as prices rise, it's a warning sign of underlying financial strain. If economic conditions weaken or a recession hits, that fragile balance breaks quickly, turning pension stress and housing instability into a reinforcing crisis. Number 11. Connecticut, the demographic death spiral. Connecticut is facing a long-term decline driven by a toxic mix of debt, population loss, and aging demographics. The state now carries $27,031 in total liabilities per resident, the highest per capita burden in the country, including roughly $37 billion in unfunded pension obligations. That level of debt would be challenging under ideal conditions, but Connecticut's demographic trends make it nearly impossible to resolve. Between 2020 and 2023, the state lost about 21,000 residents, and the population decline hasn't reversed. At the same time, the demographic profile continues to skew older. Fewer working-age residents means fewer taxpayers supporting a growing base of retirees, creating a fiscal math problem that simply doesn't work over time. Economic stress is already showing up in the labor and credit markets. Unemployment has risen from 3.2% to 3.8%, and Moody's has downgraded multiple Connecticut utility providers, a clear signal that broader credit concerns are spreading beyond the public sector. Housing is caught in the middle of this slow unraveling. High costs push young families to look elsewhere, while aging homeowners eventually list their properties into a market with weakening demand. The result isn't a sudden crash but a slow-motion housing crisis, where declining demographics steadily erode prices, liquidity, and long-term stability. Number 12. Arizona, the affordability breakdown. Arizona has crossed a critical threshold where affordability has fully unraveled. In 2024, the state managed to close a $1.4 billion budget deficit, but it did so without leaving any meaningful financial cushion behind. At the same time, housing costs have risen so sharply that Arizona shifted from being broadly affordable to clearly unaffordable in just a few years, moving decisively in that direction between 2019 and 2023. The housing slowdown is already visible in local markets. In Tucson, home prices have fallen 2.1%, bringing the median value down to around $381,400. Looking ahead, CoreLogic is assigning a greater than 70% probability that prices will continue to decline, signaling that the correction is far from over. Fiscal policy has left the state exposed at exactly the wrong time. Arizona's 2021 flat income tax cut reduced ongoing revenue just as spending demands began to rise. That trade-off might have seemed manageable during stronger economic conditions, but it now leaves the state with little to no fiscal capacity to respond when recession pressures intensify. With affordability already stretched, housing prices weakening, and budget flexibility exhausted, Arizona enters the next downturn with very few tools available. When economic conditions deteriorate, the state will struggle to cushion the impact, both for homeowners and for the broader housing market. Number 13. Oregon. An employment shock during supposed expansion. Oregon is flashing one of the most alarming warning signs in the country. During what's still being labeled an economic expansion, the state recorded the sharpest unemployment jump nationwide, with joblessness rising 0.88 percentage points to 5%. That kind of increase shouldn't be happening in a healthy economy, and it points to deeper structural weaknesses that are already forming beneath the surface. The state's fiscal setup only makes matters worse. Oregon relies heavily on a volatile tax system that depends disproportionately on high-income earners. As unemployment rises and incomes become less stable, tax revenues swing sharply, creating financial instability at the exact moment the state would need steady funding the most. Broader pressures across the Pacific Northwest are converging at once. The tech sector is adjusting, remote work is reducing the economic benefits of dense urban cores, and commercial real estate stress in Portland continues to build. Individually, each of these factors would be manageable. Together, they form a fragile system that is likely to fracture once a recession takes hold. Housing valuation adds another layer of risk. The most recent data shows that 75% of the top 100 housing markets nationwide remain overvalued. When inflated markets collide with rising foreclosures and falling prices at the same time, the outcome isn't a gentle correction, it's a collapse. In Oregon, foreclosure activity is already up 20% year over year during expansion, while price growth is rapidly sliding toward negative territory. For homeowners living in any of these 13 high-risk states, there are 3 things you should be watching closely right now. First, monitor foreclosure filings in your county. Rising foreclosures during economic expansion are one of the strongest indicators of severe recession vulnerability. Second, track inventory levels month by month. When listings surge while sales stall, conditions are forming for sharp price declines. Third, understand your state's fiscal health. States without financial flexibility cannot step in when housing markets break down. Some states face multiple overlapping dangers. California and New York are dealing with both immediate housing stress and deep structural fiscal problems. Florida and Texas are confronting cyclical oversupply after building for growth that no longer exists. Illinois, New Jersey, and Connecticut are locked into slow-motion crises that worsen regardless of where the economic cycle turns. And Colorado stands out as the biggest surprise. Its 145% surge in foreclosures proves that apparent stability can hide instability that erupts without warning. The November 2025 data isn't forecasting a future collapse. It's documenting what's already happening right now. Foreclosures are accelerating, price growth is breaking down, inventory is surging, and sales are struggling to keep pace. These 13 states show the most dangerous combinations possible. Rising foreclosures paired with falling prices, fiscal stress that prevents intervention, and economic models that are highly exposed to recession. Pay attention to the numbers we've shared. Track your local market data. Know your state's financial position. This analysis makes one thing clear: The housing crisis isn't theoretical. It's real. It's unfolding now, and it's accelerating fastest in these vulnerable states. What warning signs are you seeing where you live? Drop your state in the comments and let us know whether this November 2025 data matches what you're experiencing on the ground. If this real-time breakdown helped you understand what's actually happening, hit the like button and subscribe for ongoing market intelligence you won't find anywhere else. This isn't a future prediction. The housing crisis is already documented reality in these 13 states. If you found this analysis valuable, please subscribe, share it, and check out the next video as well.